Okay, hey everyone, just want to do a quick sound check first of all, make sure everyone can hear me. Okay, it seems to be working okay. Web presentation really on managed accounts. This is really kind of a niche presentation for those of you that are interested in investing in managed accounts. And for those watching the recording, I know probably got quite a few people watching on the recording. If you've got any questions or anything that you want to ask at the end, then of course you're more than welcome to send us an email, and we'll happily go through those, go through the email and answer those questions like that, basically. So let's get going. So as you know, this presentation is basically investing into managed accounts. First of all, just a little introduction about who I am. My name is Jarratt Davis. I work at Smile Global Management in London. Smile is basically an investment management company. We work part of the Independent Portfolio Managers Group, which basically is also based in London, and manage around $250 million worth of client funds. And we specialize, Smile specializes particularly in managed accounts, basically. So that's the kind of side that we're working on. So IPM is an investment company, and then Smile is basically the trading or in managed account arm of that company that we work on. So that's who I am. At Smile, I'm head of FX, so I'm basically head of all the traders, making sure that the trading team's performing properly. I obviously trade myself, got my own managed account program that we run there, and then of course I'm also responsible for bringing through the junior traders, any traders that we have coming through. I run that as well. So that's my role there at Smile. So Aura invited us to do a presentation because there is quite a section of people that is interested in investing into managed accounts. So the purpose of this webinar is to give you a detailed understanding of the managed account industry, how it works, and most importantly, to protect yourself if that's something you want to kind of go into, basically. So let's just start with a quick. Before we get into this webinar, I'm not going to drag this out. I don't want to keep it too long. I'm going to try and do it as quick as possible, so that you're not kind of just sitting around bored, basically. We'll go through it as quick as we can, and at the end we'll have a Q&A session. So if you've got any questions, please feel free to type them in at the end. If you type them in as we go, that's absolutely fine. I'll scroll back and do that. So if a question pops into your head and you kind of think you might forget it, just type it in and then I'll scroll back at the end and go over those questions. So let's begin with what is a managed account. A lot of you probably already know this already, but basically we're going to look at a few points. So first of all, a managed account is basically whereby you as a client will put some money into your brokerage account, and then you will get a professional, or hopefully a professional trader, to trade that money, and then again hopefully make that money grow. So you're participating in the Forex markets, or any market actually, but you're obviously doing so under the guidance of a professional. So once you've got that set up, there are a few benefits that we've looked at here. So first of all, you can see at the top there, a managed account is more transparent than a traditional fund-based investment. So for example, if you want to invest into a hedge fund, you put your money in and then you don't really know what happens to it after that point. You just get quarterly or annual reports basically saying you've either made money or you've lost money. You'll have a general idea of what's going on, but apart from that, you're kind of a bit clueless. Also, you've got lock-in periods generally, so you put your money in, you can't get out for at least a few months, sometimes, usually a year, sometimes 2 years. Whereas with managed accounts, it's much more transparent, okay, because the client remains control. So you keep your money in your account, which is in your name. So basically, the broker, the trader, can't touch that money. So there's no chance of that person, taking the money and just running away to Mauritius, buying a nice yacht and sailing away into the sunset with your money. That's not going to happen with a managed account because they never have any access. The only access they have is to obviously trade that money in the markets, which of course is something you've agreed to. Now the other thing, of course, is it's uncorrelated to other forms of investment. So the idea behind managed accounts, of course, is that if the stock market crashes, if the property market goes down, theoretically, your manager, if you've got a good money manager, he will either be keeping you out of the market in those times, or he will be riding the waves created by those crashes and stuff like that. So basically what I'm saying is you can buy or sell when involved in a managed account program. Your account can basically profit from, theoretically, any market environment. Again, it does depend obviously how good your money manager is, but that's the benefit to it. You think about things like the lost decade in Japan, if you've probably heard of that. The lost decade in Japan is basically where asset prices in Japan kind of fell and didn't move for 10 years or 20 years, depending on which sources you look at. So if you'd have bought assets in Japan, traditionally like stocks, property, stuff like that, at the peak of that lost decade, you would basically not have made any money for around 10 years or more. And you think about the financial crisis in the Western world, the UK, if you'd have bought stocks, maybe if you'd have bought the FTSE at the peak just before the financial crisis kicked off, it wouldn't have taken you 10 years, but it would have taken you a significant period of time, 5, 6, 7, 8 years before the market returned back to its original level. So just to get back to where you started, you've basically lost out multiple years where you've actually just been sat in a loss until the markets recover. So the idea of a managed account is that when that stuff's kicking off, your long-term investments are just doing their thing, and in the short term you can actually make some money, and it's a lot more active, you know, and it's not related to those things that are going to cause traditional investments to kind of falter, basically. And then, of course, in line with the extra activity, the aim is to get higher returns. Okay, obviously that includes higher risk, but we're aiming for, you know, we aim for around 20 to 30% a year on the managed account programs that we run. Some clients request lower risk, so they go for kind of less than that. Other clients request slightly higher risk, so they're aiming for higher than that. But essentially, the activity and the action that we're taking in the market, we're aiming for slightly higher returns than those traditional. So if you think about it, property prices double every 10 years. Stock market averages around 10% a year, averages I say. So you want to really try and be beating that, basically. As a money manager, our view is to kind of make it a better investment to that. So if we can do between 10 and 20%, that's good. 20% or more is ideal, is perfect. That's what you're trying to aim for. Because otherwise it's not really worth having a managed account program in the first place. Now, of course, in brackets it says there with higher risk, and that means with higher risk. So the returns you can get are based on what you can lose. So if you're aiming, or if someone tells you they can make 50% in a month, that means that you have quite a good chance of losing your entire account within 2 months. Okay, that's the kind of risk reward you want to be looking at. So whatever you can make, you can lose. So if someone's trying to go for 1 or 2% a month, that's good, because your drawdown's going to be limited as well. You're not going to be losing, you know, you're not going to be dropping 20, 30% over a few months. You're going to be down, but you're not going to be getting hammered. So you want to base what the returns are. You need to factor that into what you're prepared to lose. And a lot of people say, oh yeah, you know, I'm prepared to take the risk. I want to make 30%. But a lot of it's just lip service. And when they're actually losing 30 or 40 or 50% of their account, it's a very different story. You know, it's a terrible thing to get into, trying to go for those returns which are just unrealistic, okay? So I'm not saying they're not possible, but they're not 100% guarantee they're not without their risk. If someone tells you they can make 30% a month with no drawdown, they are lying, basically, unfortunately. So that's the way it is. Now, managed accounts, traditionally, the managed accounts that we run, for example, are aimed at high net worth individuals, or something called SIPs, which is basically self-invested pension plans. And these people can afford to lose money, because the key there is that there is a percentage of their portfolio. So nobody is putting in their entire life savings into a managed account program. No one who has an ounce of intelligence and investment experience ever does that, ever, even with us. And we don't let people do that. If we suspect that someone is putting their life savings in, we actually wouldn't take them on as a client, okay? Because we have to do due diligence, which we'll talk about in a little bit in more detail. But essentially, it always needs to be a percentage of your overall portfolio, because, of course, you're going for higher returns, so there's a higher risk involved, okay? So that gives us a little introduction as to what managed accounts are. So what we're going to look at next is the online managed account scams, which you've probably either been a victim to, or you've seen. Maybe you're tempted, maybe you're thinking about investing into a managed account program that you've seen, maybe, you know, having a little look. Well, this webinar is going to help you decide whether that's something you should risk your money in or not. If you have and you've already lost money, then, you know, I'm sorry about that. I'm sorry to hear that. And maybe we can help that stop, or help stop that happening again. So let's have a look at what we're going to look at here. So how does a typical scam work? Well, in the industry, we call it churning and burning, okay? We call them spank shops, boiler rooms you might have heard of. And essentially, With Forex, how the scam works is this. So you'll meet a trader or a money manager or a website, and they will basically convince you that they can make money. They can maybe make 30-40% a month, dazzling returns, and you'll believe them. They'll show you evidence of this in the form of maybe statements or some other kind of track record that they'll show you, and you'll take that and you'll love it. Now what will happen then is that then you'll open an account with the broker, you'll put your money into that, you'll tell the broker everything's kosher, you want this guy to trade your money, and then the trading will begin, and then after a while you'll lose vast sums of money, big percentages of your account, if not all of your account, fairly quickly. I think if you've survived 6 months of a churn and burn, you've done well, but some of them can drag it out, but generally the idea is that you lose big chunks of your money. Now the idea is that the money manager will then convince you to keep money in the account or even put more money in so you can make it back. They'll come up with some reason why it happens, some nonsense about the news or the markets. Try and convince you and say, look, if you put more money in, I can make this back. And they'll basically try and drag that out for as long as possible. Obviously, all the while, your money will be lost. Now, the goal of the trader here is to just keep the account open. Okay, believe it or not, the trader isn't trying to lose your money. The trader isn't interested in you losing your money. If you can make money, that's good. That's even better for the trader because it keeps the account open longer. Their goal is to keep your account open and traded for as long as possible. And the reason for that is because they will tell you that basically you're going to pay a performance fee. So 30%, all the profits they make, you'll pay 30%. If they don't make a profit, you don't pay. So in your mind, you think that's a great deal because if they're not making a profit, I'm not paying. It's not in their interest to do that. They're going to be putting all their efforts into making a profit. Otherwise, they're not going to make any money, right? Wrong. So on a churn and burn, what will have happened in the background, before you even know it, is basically that the broker will have done a deal, or the trader will have done a deal with the broker, and they will have done a deal whereby the trader will say to the broker, look, I've got these clients I want to bring in. I'll get them to open an account with you. The broker will love that, obviously. And the deal is, if we trade that account, I want to take a percentage of all the commissions you make because the broker makes the money from commissions. So the broker will obviously say yes, and let's just say it's 50-50. So if the broker charges commissions, the trader will get half those commissions. If they don't, if they charge the spread, what will happen is the broker will just put a pip onto the spread. So if the spread's normally 1 pip, the broker will stick an extra pip on, and that pip will be the trader's pip. So every time they take a trade, the trader will make a pip, okay? So if you're trading standard lots, they'll make $10. If you want to make more, you trade higher. So the trader now is in a position where as long as he's placing every time he pushes the button, he makes a pip. Doesn't matter if the trade wins or loses. So the broker makes their commissions, the trader takes their pip, okay? So basically, that's how a churn and burn works. So as long as the trader keeps trading, every time they place a trade, they make money. Now, this is where it gets churning and burning. This is where the accounts start to get hammered. If the broker's trading a standard lot and making $10 a trade, that's lovely, but why not make $100? Why not trade 10 lots and make $100? So they do. And then if you're making $100 a trade, why not take 10 trades a day? Which they do. So now the guy's making $1,000 a day off your account. So as long as it's alive, and as long as he's pushing that button, he's making $1,000 a day. Now, as a client, you have got no idea this is going on because you just think it's performance fee based. And the trader's not going to tell you what's going on. And that's how a churn and burn scheme works. Now, obviously, the trader can't trade. He's not very good at his job. He's only interested in the commissions. And eventually, the account will die. Your money will be gone with it. But the trader will have made a significant amount of money in the meantime. Now, unscrupulous traders can literally make hundreds of thousands of dollars each month churning and burning client accounts, okay? It's very lucrative, and all you need is a broker who's not the highest integrity, which is plenty of brokers out there like that, because you've got small brokers looking, they need clients and commissions to stay alive themselves. They're going to turn a blind eye. That's how a churn and burn scam works, okay? So if you've ever had that happen to you, that's basically what's happened. And to this day, you probably don't even know about that, but that's what's going on. Now, why do people get sucked in? Well, basically, there's 3 reasons: greed, desperation, naivety. So if you're greedy, you think you want to make 50% a month, you're going to go in, Okay, the trader's going to tell you this, he's going to show you track records, you're going to want to believe it, so you get in. You're desperate to make money. Maybe you've got no money, you've got your last $10,000 or $1,000, and he tells you he can turn that, you can double it every month, and in a few months you'll be living off it. No more money worries, you can pay off all your credit cards, everything's going to be just fine. That's desperation. So in desperation, you put it in. Or there's naivety. When I started trading 10 years ago, over 10 years ago now, I actually began with a managed account. That's how I got into forex trading. I invested into a managed account in my naivety, and I actually was the victim of a churn and burn. Okay, and I didn't know it was a churn and burn until I actually became a professional trader myself many years down the line. That's how hidden those scams are. Okay, I didn't even realize what had happened after it had happened. I just realized that I lost, 20% of my account and my friends and family account in a week, and that wasn't right, basically. So there's 3 reasons. Hopefully, if you're greedy or desperate, this presentation probably isn't going to stop you from having a punt because you're greedy or desperate. But if you're just naive, then hopefully this can save you some money, or at least stop you from having those experiences again if you've already been scammed. Now, that brings us to the next point. How can we avoid being scammed by these, what we're going to call them, programs we'll call them? So there's a few key things. First thing you need is credible regulation. So what that means is the trader should not be managing people's money unless they are regulated by a credible entity. So you might find a website and they'll say, you know what, we're regulated by the Cyprus Regulation Authority or the Mauritius Regulatory Board or whatever they call it. None of that is credible. Okay, there's no anyone can get regulation in those environments. You could literally open up a website and go and get regulated in Mauritius or wherever. Nothing against Mauritius personally, but any of those little islands off the coast of Africa or around the Caribbean or in the Pacific, they're not the places you want to be regulated. I'm talking about the US, I'm talking about the UK, I'm talking about a major European nation, an EU nation, Japan, Australia, the G8 nations, basically, a credible regulatory environment, because those regulatory environments are strict and they make sure that anyone who is regulated or who's registered adheres to those strict code of conduct. Okay, so if they are churning and burning obviously is not allowed. If anyone gets found out to be churning and burning, they not only get banned, but they also get fined and put in prison, basically. So that's the protection you need. So first of all, they need to be regulated in a credible environment. Then they need a physical office. Okay, you need to be able to literally go and knock on the door and visit them and see the trading team in action. If you can't do that, don't do it. Okay, and now a lot of people might say at this point, well, my money manager doesn't have that, but I trust him. And if that's the case, we're going to talk about how you can get around this later on. There's a way around that. There's a way where your money manager can be legitimate and credible, even if they're not right now. There are routes they can go down, and as a client, you should be pushing your money manager down that route because you want to be protected. And then, of course, finally, there needs to be evidence of longevity. This company or this firm or this trader needs to be proven, okay, needs to be proven over the long term, okay? So if you've just been around for 2 months, then, or if the trader's been around for 2 months, they might not be around in 2 months from now. If they've been around for 10 years, it shows A, they know what they're doing, B, they must be trusted, and C, they haven't been closed down, basically. So it just, longevity doesn't mean much, but it's probably the least of the 3, but it's very important. It's a good indicator of overall, credibility. Now, I can see some questions coming in, and if you've got a question, type it in. I will come to it at the end. And again, we'll talk about if you haven't got credible regulation, if you haven't got a physical office, you can get access to those things and become credible. There are ways and means to do that, okay? And we'll cover that a little bit later in the presentation. So, the final thing, of course, is realistic expectations. Now, if someone's telling you that they can turn $1,000 into $1 million in a year, you're gonna basically, that's unrealistic. Because if they could do that, they would have all the money in the world and they would be rich beyond anyone's wildest dreams. Because if you can turn, $1,000 into $1 million, how long is it going to take to turn $1 million into $1 trillion? It's the logic there. So don't be sucked in by unrealistic expectations. You can beat the market. A good money manager can beat the market, can do it over a sustained period of time, but there's a whole host of reasons why you can't do it at high leverage. Okay, and remember, in order to make really high returns, you need to use high leverage. You need to be risking a lot, and if you're risking a lot, eventually you're going to get hit. You're going to get wiped out, basically. So, for example, it's not necessarily that you're a terrible trader. Let's just go through a few reasons why you can't sustain massive returns. First of all, you might have heard of a term called black swan events. A black swan event is something that you basically don't know is going to happen. It's a big thing in the market. At the beginning of 2015, remember the SNB from Switzerland removed their floor on the Euro-Swiss pair. Remember the chaos that caused. The Euro-Swiss pair dropped about 40% at its peak. Well, if you were even trading at 3-to-1 leverage, you'd have wiped out your entire account. Bye-bye. It doesn't matter how long you've been trading. It doesn't matter how good you are. It doesn't matter what you were doing. If you were the wrong end of that position, literally within 10 seconds, your entire life's work is gone, basically. And not just your account, but your client's account, everything. It's gone. That's one example of why if you use leverage, eventually you could get hammered, basically. There's periods of volatility in the market. Again, of course, similar moves. So there's lots of reasons. That's the black swan events are just one reason why that if you use a lot of leverage, eventually you'll get hammered and wiped out and be gone. So that's why you need to have realistic expectations. Now, if a firm is trading realistically and they're not using leverage because they want to be as sustained as possible, they want to have a big lifespan, and they're doing things properly, and they want to have a lot of money under management, then it's not in their interests to trade a $1,000 account or a $10,000 account. Because, I mean, maybe you've got a money manager on the way. I mean, I accept money managers on the way up will trade smaller accounts, but if you're a good money manager, you are in a big pool of unscrupulous individuals. Okay, you're literally mixing it up with the dregs of the industry down there. And I admit you've got to come through that to get to where you want to get. That's fine, but there are ways and means to do that, and we're going to talk about that in a moment. If you are a credible money manager and you're at the bottom and you're looking to work your way up, there is a way out, a way to do that, a shortcut, so to speak. But another thing to look out for is the realistic investment minimums. So, for example, we at Smile, our investment minimum for a standard managed account program is £250,000 or $400,000. Okay, because quite simply, it's just not worth. We're regulated. We've got offices in the city. It's very expensive for us to keep the lights on every year. Just to exist costs us a lot of money. So it's just not worth having $1,000 or $10,000 accounts. And the other reason is because we're only aiming for, professional investors, not retail clients, again, which is another sign. So you can also get an idea of whether a company is serious or not based on the minimum investment that they take. Okay, again, that's just a rough guide, but it's something you might want to pay attention to as you move forward. So let's now look. That's what you look for in a scam, or I think scam. There is lots of scams, but a less than credible managed account program. And if you've got a managed account program that you're trying to set up, this can help you as well because you know what not to do, basically. So what are the signs of a credible managed account program? And I'm just going to use what we do at Smile as a template, basically. So basically, we're going to look at two things. First of all, there's some core things that you need from any program. Now, I've already looked at credible regulation. Remember, that's in a country that's credible, okay, not some offshore jurisdiction or some cheap place. Next, you need an office, a physical office, because clients should be able to come and see you and see exactly how it works. Third is longevity, so you need to be dealing with a firm who's been around for a while, multiple years. I'd say over 5 years is a good sign of longevity. Then, of course, you need a track record, okay? But believe it or not, the track record isn't actually the most important thing because the track record needs verification. Okay, you need a third party to verify that track record, basically. So if you've got an audit on the track record, and so for example, we use audits. But so if you have an audit on the track record to say that in the auditor's opinion the results they've checked and the results are real, that's a good start. Okay, it's a good start, and that's something that you need, obviously, so you can have an idea of what kind of returns you can expect. The next thing you need, or the next thing that firm or company has to be providing, is a fully regulated broker. Okay, and again, if you've got a good firm, so for example, if we used obviously we're credible, but if we then partnered up with a startup broker in Papua New Guinea with no regulations, or it's just kind of flying on the seat of its pants, just doing whatever it wants, that would kind of bring the whole thing down, because the broker needs to be credible and regulated. And the reason anyone needs regulation is so that they are accountable to a code of ethics and a code of conduct. Ironically, the rules of regulation don't apply to someone who's not regulated. So if you're not regulated, you can literally go around doing whatever you want, basically. If you are regulated, you then all of a sudden have to, adhere to that strict code of conduct, which is of course a protection for the client. And then of course, finally, the program needs to have appropriate fees. Okay, so basically, an example of this is a performance fee based on a high watermark. And again, you want to watch out for churning and burning. You don't want the regulate. I mean, for example, the FCA in the UK is actually coming down on commissions and churning and burning, that kind of thing. So you want to make sure that you're not going to get churned and burned. And again, that's all part of having a regulated broker, because a regulated broker won't work with an unregulated money manager. Okay, so the chain kind of meshes together and becomes more solid, and basically becomes more of a protection for you. Okay, so they're the core things you want to look out for. Maybe even worth writing those down. Now, the process of investing into professional managed account program is as follows. You should, if you've got a good money manager, be following this process. First of all, something called KYC, which is know your client. So the firm should be checking you to make sure that you are an appropriate client. If it just takes anyone's money, that's actually a bad sign. Okay, we wouldn't take anyone's money. If someone came to us and said, "Hiya, I'd like to put in, 100,000 or 200,000 or $1 million," the first thing we make them do is fill out a client form where they have to detail basically their personal details, financial status, incomes, due diligence, anti-money laundering. We basically need to get to know that client first of all. Then they need to apply for the managed account program, and if they pass that, then we'll pass on the broker paperwork to open the account. Then they'll sign the power of attorney giving us the rights to trade the money, and then of course trading begins. Anyone who just takes on any old person with any old money, that's a bad sign as well. Okay, so bear that in mind. That's another key thing to watch out for. So let's take a look now at your steps to ensure a safe investment. What can you do to make sure that if you want to invest in a managed account program, or if you've been burned in the past, you don't want to get burned again, this is what you need to do. First of all, you need to search out firms that have all of the core things. Now, this is what we're going to talk about next. If you're a manager, if you're an IB, or with some good money managers underneath you and you're trying to promote them, or you're a money manager yourself and you want to get some clients and break into the industry, and you know that you're surrounded by dross basically, and you're trying to get out of it and differentiate yourself, there are ways and means you can get those core things of credibility. Okay, so for example, there are lots of firms. Smile, we are one of those firms actually, that will take traders in. We will assess them. We will monitor and audit their track record. And if we believe that they're a genuinely good money manager, Smile will actually take that trader under our wing, under certain circumstances, not always, take that trader under our wing and give them that coverage, provide them with that credibility, and then that money manager can then run their business, bring clients on board, it can run their program, it can get clients, it can do all that stuff, it can trade away, because it's now offering its clients a regulated product. Okay, so it kind of absorbs all the credibility of the umbrella firm, so to speak. Okay, so don't lose heart if you are one of those in that situation. That's basically a shortcut you can do. And if you're a client and you've got a money manager who's talking about this, and you think to yourself, you know what, he's good, he hasn't got any of these things, but I believe in him, you can literally say to him, look, this is what I want you to do. If he's a good trader and he's got a book of clients, it's only going to be a step up the ladder for them. So if they've got objections to doing that, that's a key sign. Because if an umbrella firm, like for example, like Smile, rejects that trader, it's because there's something dodgy going on and they're not quite who they say they are, basically. Because if they are churning and burning accounts, a firm like Smile would not want anything to do with them, because that, we would get shut down, basically. So that's a good little test. If you found a funny money manager, kind of nudge them towards going under an umbrella or getting that set up. If they, kind of nudge them towards going under an umbrella or getting that set up if they can't do it on their own, which is fine, because I was in that position myself. I was a managed account trader. I came to Smile under that scenario several years ago, and I kind of worked my way up into the company. So it's possible, and that's what you can. That's another step you can take. Okay. Now the next step, if you've done all that, is carefully discuss with the firm what you're after to assess suitability. So just be honest. Tell them if you're trying to make 50% a month. Tell them. Okay. And if it's a good firm, they'll tell you, sorry, we can't do that. It's not possible. But a good firm will be honest with you. If they go, yeah, great, we can do that. Let's get your money on board. Again, something's dodgy, because they haven't got your best interests at heart, basically. Okay. The next thing you need to do is you need to check all sources for potential issues. Okay. So now you've got the firm. Let's say take Smile as an example. Now you need to do your background check. So it's okay, Smile telling you that they're amazing, but what stuff can you dig up about them online? What about the FCA register? Have there been any complaints against them? Check their number to make sure they are indeed registered, or the parent company. Contact the broker, see if there's any complaints that side. Just do as much research as you can to see what other people are saying about the firm before, of course, you risk your money investing into that program. And then, of course, you want to monitor the investment closely, which everyone will do anyway, to ensure that the trading is in line with the outline. So if once you've sat down and discussed your needs, if the firm or the trader has said, this is how I trade, this is my maximum drawdown, this is what you see, blah, 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 and then you start to notice that the trading is nothing like what they promised, again, that is a, so maybe you've been cheated and lied to and they've got to that stage, but as soon as you've noticed that, that's a good time to stop all trading and take a closer look and figure out what's going on. Okay, so it doesn't just stop once the money's invested and the traders start trading. You need to keep monitoring that investment and make sure that they're trading in line with how they promised to trade your account, basically, if that makes sense. Okay, so they're the steps that you need to take, and again, maybe take some time to write those down and read them. But basically, I can promise you this: a managed account firm, even Smile, we at Smile can never promise that we'll make the client money. You can't promise that because you don't know. Okay, if there is a big black swan event or the market goes particularly haywire and you get caught out, that's just trading. Okay, that's why high net worth individuals only put a small percentage of their portfolio in. Generally, we've got a pretty good chance because that's what we do. But no one can promise you that they're going to make money. But what I can promise you is if you follow these steps, you won't get scammed, you won't get ripped off, you won't get churned and burned, and you won't just see your money flitter away down the drain. You'll be protected as much as humanly possible, and if you do lose your money, it will simply be to genuine market forces, okay, which is basically about the best you can get from a credible managed account program. Now, has anyone got any? What we're going to do now is go to a few questions. I've tried to keep it short and sweet, 40 minutes. I don't think I've done too bad. So if you've got any questions about the program that we run, maybe you're trying to get an idea of a bit more detail about how a credible managed account program operates so you can compare and contrast, or if you've got any issues, maybe you've had a bad experience with a managed account, maybe you have been ripped off, or you've had those negative experiences, please feel free to ask the question. I can see a couple of questions in there already. If you've got no questions, that's fine. If you're watching this on the recording, as I'm sure a lot of people are, please feel free to send an email in with the questions and we'll get those questions answered. So basically, just one that's coming in, Maurizio. As an IB in Peru, there's no regulation in this market. We don't have offices in LA and we have no longevity. How would you approach that? How can the clients verify your accreditations? Well, again, what I would do is I would try and find a firm that you can partner with, like an umbrella firm to partner up with, basically, that does have that coverage. So that tells the clients that you're being serious. Does that make sense, Mauricio? Does that help? So if you can find an umbrella firm and basically partner up, that's probably the best way you can go about it. Of course, the other way, obviously, is the long way around, and that is to basically do it yourself. So you get set up, you apply for regulation. So here's just a clue here. If you want to get regulated in the UK on your own to be a money manager, a self-operating money manager, the initial costs are going to be around about £250,000 in total. Okay, so if that's something you want to do, then that gives you an idea of where you need to be. So you need to kind of have quite a bit of capital lined up really in order to do that. The ongoing costs of being regulated can be anything from $50,000 to $100,000 per year, because you need a compliance officer. So you need someone in the organisation, and you can outsource this, but a compliance officer is on about £150,000 a year. So you need someone to basically make sure that your firm's operating in the right conditions, sticking to the guidelines, adhering to those standards on a yearly basis. Regulatory bodies will post updates. They'll post changes to policy and stuff like that. You need someone who's switched on to that to make sure that your firm is also staying in tune with those changes, basically. So there's two ways you can go. You can either do it yourself, which is pretty expensive, or you can go via an umbrella firm. But that's not guaranteed, because obviously they're going to want to check you out and make sure, because once they take someone on, then they're responsible for everything they do, basically. So of course there's a big risk for them. So if you're not quite operating in a way that would be deemed credible, then that's kind of the way you want to go, basically. Vlad saying he likes trading fundamentals. Do we plan on doing other webinars about fundamentals, or what would you recommend to read and understand the market better, the way the market moves? Good question. I mean, yeah, like, as you know, obviously we trade fundamentals. Yeah, there'll be lots of stuff. I mean, we do lots of stuff, really, Vlad. If you follow the either the socials, or if you subscribe to the emails, we do stuff from time to time. So if you make sure you get your emails into the inbox, so that when we do send an email out, you can get it. That's probably the best thing to do. We have probably got some launches coming up actually in the next few weeks, so keep your eye on that, and there'll be something coming up, I'm sure. We are actually doing something along those lines. Okay, guys, anyone else got any questions? Or okay, Vlad, there is some more stuff coming up, definitely, over the next month, I'd say. So keep stalking. Maurizio, I don't understand. What do you mean by an umbrella firm, like another company that put their credibility to support us? Yeah, exactly. So they will take you in, and you'll get all the benefits of their credibility. You'll be surrounded by their credibility, and they'll vouch for you, so to speak. But they'll also be responsible for you. So that's a quick way of doing it. But of course, that still costs money, but it's a lot cheaper than doing it on your own, basically. Okay, guys, I think that's pretty much the end of the Q&A. If anyone's got anything else, please type it in and let me know. If not, I'm going to leave that there. Again, if you've got any questions that crop up in your mind after, please send us an email. Because we want to help you. The purpose of this webinar is to stop you getting ripped off, basically. Managed accounts are a tricky one. So now you've got a better idea of what a credible managed account looks like, and hopefully you can protect yourself. If you've already been burned, the worst case scenario, it's not going to happen again, and not going to do that. What I'm going to do now is I'm going to end it there, and I'll turn the mic off.